Hi, I'm Dan Passarelli of MarketTaker.com here on the floor of the CME Group. Well, one of the trades we talked about today in the Market Taker Live Advantage group coaching class was in Facebook. Take a look at a chart of Facebook. If you haven't looked at a chart of Facebook in a while, you're going to find something pretty interesting. That stock has been in a serious uptrend for a long time now, and for good reason. Facebook increased their after-tax profits by 61% this year. 31 out of 33 analysts rated a buy, and it's a social media revolution going on right now. I think that uptrend is going to continue. So the question is, how would I play it? Well, with this trade, I would take a very simple approach. Because it's such a strong uptrend and because there's so much upside potential and because implied volatility is so inexpensive, I'd simply buy a call. I'd buy a 70 strike call, probably in the March expiration cycle. So here's why I would trade just a long call instead of a spread. With the spread, I limit my upside potential. With the spread, I would use that to typically spread off implied volatility risk. I don't have either of those issues here. In fact, I have the opposite. I want that unlimited profit potential. I want that strong upside potential. I want a situation where I can make 100, 200% potentially, or I want a situation where I could take it off in a few days for a nice hefty profit if the market starts showing signs of overall weakness. Now, a couple of notes here on management. Usually buying a call is a pretty short-term trade unless there's a really strong move going on. So I'm going to have to actively manage this trade quite a bit. If the stock does continue to rise and the market starts showing signs of weakness, I'm going to make this a short-term trade probably. If the market doesn't show signs of weakness and it continues being strong and Facebook is strong, once I get about a 50% profit on this trade, what I would do is I would set a trailing stop. A trailing stop continues to allow the stock to profit as the stock rises, but if the stock falls, a stop order is triggered and I take my profits. Now what happens if I'm wrong? If this rally becomes overextended and the stock starts to fall? Simple. I'd set a stop as soon as I put this trade on. Now that's contrary to how I would manage a spread. Typically with spreads, it's hard to use stops because of the small deltas and because of the two-leg trades and getting slippage on both legs. But with a long call position such as this, I definitely want to use stops every time I do a trade like this. So I would set a stop where if the call loses 25% of its value, I'm out, I take a small loss. So there's a great risk-reward ratio. It's a great technical setup, and it's the best way to play Facebook right now. This is Dan Passarelli here on the floor of the CME Group.